Okay, good evening or good afternoon, everyone, and welcome to this new edition of the E-Axis Forum webinar. This webinar is part of a series of 3 that we started last 2 weeks ago with Stefano Giglio. So I just remind you that this year we started a new format where we will have the same issue treated in 3 webinars, one academic, one with a practitioner, and the last one with a panel of and all seminars address the same topic. And the topic of this series is to basically to what extent are climate risk priced by financial market and financial institution. Today, we have the great pleasure to have 2 presenters from the BIS, Michela, Scatigna, and Omar, Zulaica. Let me just briefly introduce the background. Michela Scatigna joined the BIS in 2001 and has worked on a variety of research projects related to international economics and financial institutions. She took a break from the BIS to work in a commercial bank in Spain as a senior economist analyzing international real estate markets. Michela holds a BS in economics from the University of Rome 3 and an MSc in economics from the Collegio Carlo Alberto in Turin, Italy. Omar joined the BIS in 2017. He's supporting central banks in their reserve management activities and the BIS in its asset management capacities with a special focus on strategic asset allocation. And before joining the BIS, he worked for 6 years at the Bank of Mexico, where he was the head of strategic asset allocation in the Directorate of Foreign Reserves. Omar has a BSc in Actuarial Science from Instituto Tecnológico Autónomo de Mexico, I hope I pronounce it well, and MSc in Financial Economics from the University of Oxford. Before moving to the presentation, and thank you very much, both Michela and Omar, to be with us tonight. We will have our traditional round of questions that you can answer. The first one is, in your opinion, are investors willing to pay a social premium for bonds earmarked for social projects, all else equals? Yes, across the board, yes, but only in certain markets. No, they're not ready for that, or you don't know. And the second question is, what is more urgent in the fight against ESG or greenwashing? First, standardizing the current available taxonomies, designing and deploying new taxonomies, mandatory disclosure, stricter ESG designation rules, and harmonizing the definition of ESG rating. So these 2 questions will help us frame the debate, and we'll let you a few seconds to answer them. Feel free to ask any question that you have in the chat or rather in the Q&A section that we have. I will relay them to the presenters. And also, if you want to ask your question directly, maybe indicate that in the chat, so we'll see if we can see if we can link you directly in this presentation. So here are the answers. So are investors willing to pay a social premium? Yes, but only in certain markets. We will see if that corresponds to your finding, Michela and Omar, or if you have something to add on that. And for the second question, what is the best way to fight against ESG washing? Mandatory disclosure is the answer that was given most. So very concrete recommendation to supervisors. And the second one, standardizing the currently available taxonomies, also harmonizing the definition of ESG. So basically 2 answers on defining better ESG ratings. So that being said, I think Omar, you start the presentation. The floor is yours. Thank you so much for joining us tonight. And we will have a question and answers after your presentation. Thank you very much.
Absolutely. Thank you for the introduction. Very kind for having us today. Before I begin, let me just highlight two things. The first is that the research being presented today was actually conducted in collaboration with two more colleagues from the BIS. Their names are Dora Zia and Anna Zabai. So some credit goes out to them. The second thing to review is the agenda of today, which should be coming up on the screen. And we'll start with a quick introduction outlining our premise. So what is it all about that we did? Then we'll go to the empirical analysis, and we will be talking about two topics in a very similar spirit, but quite different samples and variables. One is going to be about the cost of debt in the environmental space, and the second one will be the cost of debt in the social space, which we're calling, of course, S. We'll then conclude with a discussion which looks at, in a forward-looking manner, what are the potential roadblocks and solutions in the general space of ESG. So let's start by outlining our premise. And this was very clearly outlined on the paper published on the quarterly review of December 2021. And we're saying that financial markets can support the transition to a more sustainable and fairer economy. So the question is how, right? And well, the answer is by reallocating economic resources towards projects and firms that do good and away from those that do bad. Now, what do we mean by good and bad? We can use a very simple example. We may not want to support a company that generates enormous amounts of plastic waste, which, of course, among other things, pollutes the ocean, but instead, we can take our money and put it in a company which has a positive social footprint, for example, one whose goal is to promote a healthy lifestyle. So to implement this, investors must sell the equity or debt of the bad company and tilt their portfolios towards that of the good company, right? That is the premise. So by shifting capital from one set of assets to another, we have the potential to influence their prices. And that's a key idea. In the process, we are influencing, in the case of debt, firms' funding costs, which is tracked by yields. Just like when we trade US Treasuries, we affect the state of the yield curve, right? Um, and what happens if all investors pile on to do the same? Well, there would probably be a lot of power to this repricing. So in our presentation today, we want to show you some empirical evidence that this empirical mechanism by which investors influence the cost of capital indeed works, at least with current information. Now, before getting into it, it's important to note that we think that the mechanism needs some conditions to work. The first one is that there needs to be reliable information. We're going to call the information signals about the ESG benefits generated by the projects or the firms. You know, something that tells investors that the companies or the projects are indeed good. And the second condition is that investors need to respond to this information, right? They need to understand it and they need to be consensus that the signals can be put in use. Just to quickly illustrate, let me draw an analogy. Think of traffic lights. So everybody here knows what they are, right? We can almost take that for granted. What do traffic lights do? Well, they signal to drivers and pedestrians where they should stop, where should be careful or go. So easy to say, right? However, we take traffic lights for granted, but their history actually starts in 1914. So it's quite a few decades since we all had to adapt to that information. And I just want to use that example to simply illustrate how essential it is for signals to be pervasive, to be understood by everybody. It takes time. And the kinds of signals that have been designed to point out the ESG benefits of a project or firm are still in development. But they're very important because they may be able to tell us how bad we're doing to the planet or society at large, right? Just like the traffic lights may tell you how bad it may be if we don't stop when we see a red light. So yeah, like decades ago for traffic lights today, there are ongoing efforts to design the signals and of course make sure that investors understand them and that they can use them and respond to them. Now, with that premise out of the way, let's go into the empirical analysis. And now remember, we're just focusing on the cost of debt. And the idea is to tie ESG signals to investor responses. Theoretically speaking, we are saying that the responses may come from two channels. They are not exclusive. We actually think of them as complementary. The first one we call the risk channel, and this answers the question, does the information or signal tell us anything about the asset's riskiness? So whether the assets yielding ESG benefits are perceived as less risky, all else equal. And the second channel we call the preference channel. So this answers the question, does the investor have a preference to support sustainability goals beyond risk considerations? And we're going to focus on this second one. What it means is that we are going to look for empirical evidence that the preference channel matters over and above any risk considerations. And this is going to be in two market segments, as I have described a moment ago. In e-space, we're going to be looking at the impact of a firm's carbon footprint. What is carbon emissions? How many tons CO2 does a company directly or indirectly consume and emit? And in S space, we're going to be looking at the social bond label, which is usually what is done to earmark projects with specific social benefits. And on screen, you're seeing two examples, such as social housing and healthcare access. So I will take care of describing the empirical analysis on the E space, and I will then pass the word to Michela, who will walk us through the analysis on the social space. Now, what's our hypothesis here on the E-space? We're going to say that investors demand a higher yield when trading bonds issued by corporations with heavier carbon footprints. What this means is that if you pollute more, then we would prefer you less, and by construction, the yield of your bonds should go up. So indeed, the signal will be a firm's carbon footprint as measured by carbon emission data. This is already becoming a standard in the industry. More recent work was done, for example, in the equity space. But the reaction, where do we measure it? Well, we focus on secondary market corporate bond yields to gauge the investor's response. So you can think of it this way, given that our reaction variable is the corporate bond yield, we're going to need a form of them as our variable to be explained, and our signal, the corporate emissions, will be our explanatory variable, among, of course, other things. So let's take a quick look at each of these variables so that we know that we understand them. First, we'll take a look at the bond yield data. And to be clear, we actually run our analysis on option adjusted spread data, OAS. We're going to dig out monthly data from Refinitiv for bonds issued by firms in the US and the European Union. And we're going to be treating these samples separately because of regulatory issues. So we're going to generate our bond samples by applying some filters that are quite standard in the literature. We're going to focus on fixed and zero coupon bonds, for example, with maturities above 1 year. We're going to leave out all structured notes, asset-backed securities, convertible notes, etc. Things that may pollute the message that we're looking for. And note that we are talking about option-adjusted spreads to government because we want to control for the optionality that is embedded in callable bonds. We don't want to get rid of callable bonds because they are a very important part of the universe of fixed income. In fact, it is about 60% of our sample. Just to illustrate how important it is to control for this optionality, I'm showing on the left-hand side here the average option-adjusted spread over time in basis points across all the bonds in our sample. In red, you've got the callable bond yield, or the OAS, and in yellow, you've got the non-callable one. So important to keep this distinction in mind, and this will actually go into our regression analysis. Now, what else should we keep in mind? Well, one important thing is naturally credit ratings. Uh, we know that the level of option adjusted spreads is dependent on the riskiness of the issuer. And we've got a good gauge here. Our sample goes all the way from AAA, as you can see on the x-axis, more on the left-hand side, up to, or shall we say down, to double C, below investment grade. And you can see that there's a very clear difference in the average option adjusted spread when we change the credit rating of the issuer. So it is very important also to control for this. All the option adjusted spreads on screen are, of course, at only one given point in time because credit ratings are also time varying, right? So we need to keep this in mind as well. Now let's take a look at carbon emissions data. We gathered data on both direct and indirect emissions. These are called Scope 1 and Scope 2 respectively. And our source is S&P TrueCost. Remember, we're only working with firms from the US and from the EU. What we're going to do is collect this data for all the years available. This data is yearly, unlike the bond case where we have monthly data. But in order to make it part of the sample, we're going to repeat this monthly observation every month for any given year. To give you an example of what it looks like, the chart on the left-hand side shows, again, a time series, but this time it's yearly, and it is carbon emissions over time across all firms according to the type of emission. In blue, we've got Scope 1, or emissions from production, and in green, you've got Scope 2, or indirect emissions from the consumption of energy. And you can see that the level is quite different. Now, even though the history available starts in about 2005, as you can see, actually the comprehensive number of firms is only available since about 2016. There's quite some differences on which firms have reported or are part of the TrueCost database. So we only focus on samples after 2016, in fact, 17, because as you will see in our regression model, we are using lagged data. So carbon emissions over time are available since 2005, but we're going to chop the sample to make it fairer to our estimates to use a more complete picture of firms starting in 2016. Now, carbon emissions data also vary depending on the sector. And this is probably obvious to many of you watching, but I just want to illustrate it by using the chart on the right-hand side. We have used several of the sectors to classify the firms, and then we have taken the average emissions across all the firms for one of the years of our sample, in this case 2020. And then it becomes evident that there are some sectors that are much more energy intensive, like materials, energy, and utilities, which are sorted at the top of the bar graph. And then there's almost like a very big step from utilities to consumer staples, where we actually start defining the set of sectors that we will consider non-energy intensive. So this distinction will be very important. We will say, going forward, energy intensive sectors refer to every firm in the materials, energy, and utilities space, and the rest will be part of the non-energy intensive space. Another important distinction. Now, what is the model? And this is, I think, the juicy part. So our model consists of decomposing option adjusted spreads into two components. One is going to be related to expected default. This is the traditional literature. And the other one will be capturing the determinants of carbon emissions. And really, what we're doing is trying to build on the literature that explains the credit spread puzzle. As you know, option adjusted spreads, or spreads in general from corporate bonds, are well known that, to not be fully explained by probabilities of default. There are many other variables that explain them beyond that. For example, The financial health of the issuer can also be seen in financial statements. The liquidity of the bond itself, we talk about liquidity premia, and the features of the bonds, of course, like duration, the age, the coupon. What is not yet known, and this is what we're trying to explore, is if the carbon footprint adds to that explanatory power beyond probabilities of default, and this is indeed what we're going to attempt. So our equation looks like this. We've got the option adjusted spread, or the corporate bond yield above the risk-free rate, being explained by first expected default, which we model as the odds of default using 5 years ahead. Other known determinants, which are bond specific, for example, duration and liquidity. And finally, our novelty, which is the carbon footprint. It's going to be either scope 1 or 2. We're going to do each of these one at a time. Now, getting a little bit more mathematical, we're going to have the option adjusted spread of bond I for firm J at month T, as explained by the default probability for that given firm, set of controls, which is vector Z at time T. This is bond specific. Some fixed effects, which are month and year. This is also standard in the literature. And finally, our carbon footprint. We're gonna denote it by CE, which simply means carbon emissions. And as you can see, this is firm-wide, J, and it's going to be lagged 1 year to control for the fact that carbon emission data is not immediately available when you analyze a company today or any day. Now, the results I will present only based on this one here. This is simply to make everything easier to understand, but rest assured that the expected default results over here and the other known determinants all bear the specific significance and the expected signs as one would see in the literature. What we will be reporting then is what is the coefficient on the carbon footprint, first for scope 1 and then for scope 2. And this would answer the question, if we found statistical significance, whether the carbon footprint has some effect on option adjusted spreads. So let's dive into scope 1. We first take a look at direct emissions. And we're going to make it even easier to interpret by displaying it in this way. We're going to calculate what the change in option adjusted spread is for a 10% increase in scope 1 emissions. And the chart on the left-hand side of the screen shows you one estimate for the US and one for the European Union. You'll see there's an X. This would be the value of the coefficient for that specific increase of 10%. And then around it is a confidence interval, which is the green bar. And for most statisticians, they will know if this bar touches the 0 in the y-axis, this means the statistical significance leaves something to be desired. So with this in mind, you can now see that when a company in the US increases its carbon emissions, its direct carbon emissions, by 10%, we can expect the option adjusted spread to increase by about 2 basis points. We're saying this is the preference channel because, as you know, this is the result of the impact of carbon emissions beyond that of the probabilities of default. The probabilities of default are already part of the regression. Now, what about the EU? Clearly, it's lower. And in fact, the effect is about 0.7 basis points. So not even 1 basis point of consequence as a result of the change in scope 1 emissions. And now, just to give you an idea of what the order of magnitude is, it's statistically significant, but somewhat economically negligible. And this is because the median spread in our sample is about 115 basis points. You can see that on screen right here. So if you compare 2 basis points or 0.7 basis points to that quantity, it doesn't look so impressive. but this is only the beginning, of course. Now, what about indirect emissions? Let's take a look, and the information is presented the same way. We've got one coefficient for the US, one for the EU, and we also have a confidence interval for them. And it's very clear just upon a quick glance that for the US, the effect is about 0.7 basis points. So if you increase your indirect carbon emissions by 10%, it's not even 1 basis point of increase in your option adjusted spread. And for the EU, the effect appears negative, but remember what I said about touching the zero value, the result is not statistically significant. So when you look at it like this, it seems like there is a carbon risk premium mainly in the US and mostly for direct emissions. However, we now provide some nuance to the analysis. What happens if we zoom in on firms that are energy intensive? We could say maybe these are the culprit behind the statistical significance. Remember that these are the firms that we call energy materials and utilities. And indeed, we find that they do have more material effects. So what you're looking at on screen right now is on the right-hand side, the same chart you had seen before for direct emissions or scope 1. We had about 2 basis points for the US and about 0.7 for the EU. But now there's two additional charts. One is the same analysis, but only for non-energy intensive firms. And then the same one, but for only energy intensive firms. And if you look carefully, you can see that energy intensive firms have a very important coefficient compared to the full sample, both in the case of the US and the EU. So for example, for the US, you can think of the carbon premium of being about 6 basis points for every 10% increase in emissions. When you look at non-energy intensive firms, this one over here, in fact, it's not statistically significant. So it seems like energy intensive firms are indeed driving most of the result we see. However, for the EU, there is some statistical significance here in the non-energy intensive case. So we see that the result is more broad-based, or the risk premia is more broad-based. Perhaps this speaks a little bit about the divergence in regulation among both jurisdictions. Now let's do the same for scope 2 before I wrap up my part. And again, on the left-hand side, you see the same picture we had seen before, the full sample, where the US is statistically significant and the EU is not. In the middle, you see non-energy intensive firms, and we can immediately prove that according to our t-test, the statistical significance is not there for either. And it is there for energy intensive firms in the US and not for the EU. How much bigger is it in this case? Well, it goes from about 0.7 from the full sample to about 1.2 in the energy intensive sample. So for scope 2 emissions, it seems like the difference is less pronounced and in fact not there for the European Union. We take all these results together to say that there is some evidence supporting the preference channel, so that investors indeed, over and above the risk channel, prefer the corporate bonds of companies that pollute the environment less, as measured through carbon emissions. And with this, I will pass it on to Michela.
Thank you, Omar. 1 second, I'm going to share my PowerPoint. I seem to have some issues with sharing it. Okay. I hope you can all see it. Apologies for taking a bit of time. Yes, so I will now move into a different space from the environmental space that Omar has been talking about. And I will,
Michela,
yes?
we see your PowerPoint view and not the full screen view. I don't know if it's intentional or not.
No, it's not. I was trying to, okay, I will just stop sharing again. Just let me try again. Sorry. Yeah. I really can't, sorry.
And otherwise you can continue with the PowerPoint.
Can you see it now?
Same as before. No, that's good. Perfect.
Now it's good? Yeah, I apologize. Okay. Sorry, because normally I have two screens, but today I have one. Now it's good. Okay.
It's good, yeah.
So sorry for the delay. I will jump into the second part of the empirical analysis, which basically deals with whether the similar mechanism to what Omar has been describing in the environmental space, we can find it in the social space. And so here in this part of the analysis, we are investigating whether investors value social benefit enough to be willing to pay a premium compared to projects that don't carry a social benefit. So the signal here, what we look at, unlike the carbon emissions that Omar has described, here we look at a commitment from the firm that issues a bond labeled social, and we look at whether the investor reacts to this signal. And we do this by looking at yield at issuance of the difference between yield at issuance of a social bond compared to a conventional one. So the mechanism is a well-known mechanism in the way that in the literature on the greenium has been used quite often. And so we have decided to extend it to social bonds. Why did we decide to do this? Before jumping into the results, I will just give a very short introduction and overview of what has been happening in ESG markets, in particular in bond markets, during the last couple of years, and in particularly after the pandemic years. What we can see, this is just one of the charts that we have used in our piece. We have looked at a variety of ESG awareness kind of indicators in the market. And in this chart on the left-hand side, you can see like 3 indicators, and in particular one related to climate change and one on social inequalities. And these are based on word searches, including certain terms for these 2 kind of topics that are run using Bloomberg. And then we have added also another kind of indicator that was appearing quite a bit in a financial market commentary, which were the number of firms in the S&P 500 that mentioned ESG during earning calls. And this graph shows clearly how there has been an increase in talks and attention to these topics since 2019, really. And in particular, related to social inequality, the spike is quite clear that coincided with the pandemic. And likewise, complementary to this growth in attention, there has been a growth response in financial markets by firms and governments issuance of bonds, the so-called labeled bonds. I should make exactly here a disclosure that what we look at are bonds that carry labels, either green, social, or sustainability labels. And these are labels that are attached to these bonds according to the ICMA principle of green and social and sustainability. So as you can see in the middle chart, the issuance has been on the rise quite steeply during the last 5 years. And the green bonds issuance has taken basically the biggest share of overall sustainable issuance, if we want to call it like this. Whereas social bonds were really only becoming relevant only after the pandemic exploded, as you can see from the last two bars. And this kind of brought us to writing the piece on this emerging type of market, where a new concern, in addition to climate change, was arising and was being kind of addressed by issuers by issuing more bonds carrying this label. On the last chart, you can see that nowadays labeled issuance of this type of bonds has become quite strong and quite important in the market. The data in the chart are only referring to the data that we show in the piece that are until September 2021. However, more recent data are available and they point to a total market of about 2.5 US dollar trillions. So something that a few years ago had started as something very niche has quickly taken over. And this has coincided, of course, with the awareness, but also we talk about it in the piece with evidence that more extreme climate events have been occurring. So with this background, let's just move into the exercise in the S space. So as I said, we focus on social bonds, and just a quick reminder of what does it mean for a bond to carry a social label. A social label means that the bond the proceedings from the bond are to be destined to a number of projects that are so-called social, that bring social benefits. And here you have just of this market. And I'm sorry, I have to I have to accept to log into Duo again, the VPN. Just sorry. I hope everything is fine. I'm back in. And so the currency denomination is, yeah, sorry.
We lost you for 10 seconds.
Okay, good. No, somehow I had to authenticate my connection. Yeah, so the second dimension was, I was talking about was the currency.
So probably the same problem again. Let's wait for a few seconds.
Just after the pandemic, in response to the pandemic. And the second currency was the US dollar, is the US dollar. And then there has been quite a bit of issuance in Korean won, as you can see in this graph, especially in 2021, and then followed by the Japanese yen, which is the yellow bit. So with this in mind, we went and studied this mechanism of basically firm benefiting of a discount, perhaps at issue, when they issue a social bond. How did we do this? We started looking at data from Bloomberg. We used the fixed income security search from Bloomberg, which provides the bonds that carry labels in green, social, sustainability bonds. And we only looked at the social part. We used in terms of time frame, we used data from 2016 to 2021 because really there wasn't any social issuance before. And even with this time period, as you have seen from the graphs before, issuance has really taken off from 2019. And then we restrict the universe to study only what happens in the corporate world. So corporates that issue social bonds, in order to study this mechanism of basically the social label to be able to affect the cost of funding for the firm. Other characteristics of these bonds are detailed here. So we we take bonds that are basically don't have a special payment rank, so we exclude asset-backed securities and other structures. We keep the callable and non-callable bonds. We use the bonds with a fixed coupon, and then we concentrate only on the top 4 currencies of issue that describe basically the vast majority of the universe in the social space. There were a number of tiny issues in emerging markets, and these were excluded. The only emerging market that we kept was actually the Korean won. And then, of course, the social bond label. This describes basically what we do in order to identify this benefit, this premium that the investor might be willing to pay. So like in the green space literature, following authors like the latest papers from Lacker or Watts or Flammer, we use this kind of matching technique of bond by bond to find in the fixed income space similar bonds to the social bonds in our data set that have they come from the same sector. They are also non-structured, callable or non-callable, and have a fixed coupon. And then on top of that, we match by currency, issuer, and rating. When it's not possible, of course, for some issuers, actually for quite a number of issuers, it's not possible to find very similar bonds. And then we move to a different issuer that has the same rating, and also we match the rating at the level of the security. After we do this, we clean further up by choosing the bond that has the closest issue date and maturity date. So in this way, we are looking at finding pairs of bonds that are the most possible equal, but the only differentiation is the carrying of the social bond label. What do we find? In this table, you can see a bit the summary statistics and some stylized facts of our database. We find in total 103 bonds in 4 currencies, and the distribution is, as you see in the table, is quite balanced, except for the Korean won bonds. There were quite a few. However, you can see that by size, there is quite a difference between bonds denominated in euro and dollars that have an average size of about $500 million, whereas the Korean won were very tiny. In terms of maturity, you can see that the maturity, so I have to also add that a number of bonds were excluded with maturity beyond 10 years. There were quite a few number of bonds with very long maturities to 20 and 30 years. These were excluded. So we kept the maturity from, let's say, 1 year to 10 years. And this is the distribution by currency in our sample. So you can see the similarity is very strong. And also the rating match is quite close. The number 6 indicates a rating that it's about between A and A minus, because AAA is 1. So if we go down on the scale, this is the average rating by currency for the 2 sets of bonds that we find in our data set. So with this in mind, we proceed to calculate the so-called, we call it socium, which is in the spirit of the greenium literature, basically this premium that investors might be willing to pay in order to hold a bond that has that will bring a social benefit with respect to another one, conventional one that doesn't have the bond label. How do we proxy the response to our question whether such a premium exists? As I said, we use the bond yields at issuance. So we concentrate on primary markets, and we do this at the security level, simply by subtracting yield at issuance of the social bonds minus the yield at issuance of a conventional bond, we find this differential, and this is our socium. A little disclosure about why did we choose primary market and yield at issuance. In a way, issuance has occurred really recently. So during 2021, while we were actually looking at this topic, the time period over which we could observe this yield was very short. And secondly, we can justify this easily because primary market and secondary market funding conditions shouldn't be so far away from each other. And also in the literature, there are quite a high number of works that do the same. And what do we find for the full sample of the 103 bonds, comparing the mean of these differentials, yield a difference of about 12 basis points. So basically, what we are saying is the social bonds, corporates that issues bonds with the social label can enjoy on average 12 basis points less of funding cost. And this is also in terms of significance, turns out to be statistically significant at the 1%. So the result, although it's 12 basis point, it's not a huge difference. It's somehow not irrelevant, and it's significant. But as I said, we decided then, since our sample also is including bonds from different currency denomination, and we know that the currency of denomination is quite important in financial markets, we decided to look at things more closely. Here you just see basically the results of the table in bond by bond space. So we are just plotting the social bond yields on the y-axis and the conventional bond yields on the x-axis. If the dot lie on the 45-degree line, it means that they are issued at the same yield, so there is no discount or premia. And if they are below, and these are marked in red, it means that the social bond is issuing at discount and there is a socium. And this is on average the 12 basis points that I described before. And what we also do in order to convey a more economic meaning to this number, we transform these 12 basis points in the notch, the credit rating equivalent. And we do this on a bond by bond basis. So we calculate the increase or decrease in the funding cost that would stem from an increase or decrease in the corresponding rating scale. And so for the whole sample, these 12 basis points correspond to about one credit rating improvement. And what I was just going
Michela,
to, yes?
there is
time
10 minutes. Yeah, 10 minutes. Yeah. So if you could
conclude, so
we can have some time for questions. That would be,
yes, absolutely.
Thank you.
Yeah, here we have the breakdown by currency, which was what I wanted to show you before. So this socium exists, however, is actually driven by the issuance in two major currencies, the dollar and the euro. Here we have 21 basis point of socium, whereas in Korean won and Japanese yen, the socium does basically zero, and it's also non-significant. So just to conclude, let me just summarize our piece and our results that taken together, they suggest in the two different spaces that there are that investors do respond to signals stemming from both carbon footprint data and also bond labels. In the carbon, in the environmental space, in the E space, the size of the carbon premium is not so big, but it's actually is more important and significant for energy intensive sectors. And in that space, we also calculate the economic meaning, which is about a third of a notch of a change in credit rating terms. Whereas in that space, as I said, is stronger and corresponds to more than one credit notch upgrade. Closing and going back to where we started with the poll questions. So we just conclude by saying, well, for ESG market, so we have looked at these signals and these responses, and we have found that the responses are there. However, in order to for ESG market to support the transition, to actually transform business, and have an impact, we need the signals to be accurate. And this brings us directly into the main risk of sustainability or ESG washing, which is directly related to what it is that count as ESG. So who and how it is decided, and this is the topic of the taxonomies. And the second point that it's still lacking is the mandatory disclosures. So what is being disclosed and who is disclosing it? This is absolutely crucial for making sure that the signals are accurate. So looking forward, we do suggest that there is where the work needs to be done in improving the disclosures and in reaching a universal taxonomy that it's shared by different countries, and it's actually usable by the overall financial market community. I will stop here so we can take questions and maybe go deeper in the answers according to the interest of the audience.
Thank you very much to both of you. So let me remind you that if you want to ask a question, please use the Q&A section. There are a few questions in the chat. Let me maybe start by one that I think is very key for all your results. One question by Christina Wang, who is asking how much do E and S labels affect default probability and internal ratings directly? And I think this is a key question for you, and maybe it calls for a bit more definition of or explanation about what you have as a measure of default probability, because basically the issue of this series of 3 seminars is to see also whether climate risk are already priced in. So you would interpret your result totally differently if you think, for example, that it's not priced in yet, for example, in credit ratings. So the ratings provided by credit rating agency do not price climate risk in, and then the higher yield that you observe could reflect this higher risk that is not reflected in credit rating. So, and if it is already priced in and reflected in your probability of default measure, then you have a measure of preferences. So, like a true measure of preferences for. So could you explain maybe a bit what is behind this probability of default measure, and whether you think that credit climate financial risk are already embedded in that measure?
Absolutely. So I think first it's important to distinguish between what we're doing and what it would be doing to look at E and S labels, right? So we are looking only in our carbon emissions exercise, we're looking only at the E space, and we're looking at only a part of the E space. So when companies who are creating these ESG ratings, generate a score for E, carbon emissions are only one input, and we only have insight to that part of the input. So I cannot answer whether E or S is indeed priced in the corporate bond spread, but I can say that our analysis sheds some light on whether part of this E score may be relevant for financial markets. And I think that carbon emissions have become one of the mainstreams to assess whether companies are being environmentally cautious or not. And this is why we chose this measure. Now, with regard to the definition of the default probability, we have been using 5-year ahead default probabilities by Bloomberg. These are prepackaged, and we found that they are an adequate proxy for default risk. The explanatory power that they have for option-adjusted spreads is similar to that found on the literature for those that are generated simply by using the traditional Merton model. And so we decided to simplify our work by using the time series of PDs available. Now, what we presented was for the preference channel, right? So this has to do with whether investors prefer or not ESG benefits above all risk considerations. We didn't answer whether the risk was priced. We answered whether the preference was priced. And you can find out whether the risk is priced by checking the statistical significance of carbon emissions on the default probabilities. And that is a different channel. That is the risk channel. And we do show some of these results in our paper. If you go to box B of the quarterly piece, you can see that we also find statistically significant coefficients for the carbon emissions in mainly scope 1 in the US and the EU on PDs. And what this would mean is that then carbon risk loads two ways. One, the risk that if you pollute more, then investors think you will default more probably. And second, preference, controlling for that, then we would prefer to invest in assets or therefore have an impact on the more general corporate spread once controlling for the risk. So there's the two channels. Now, if you take a look at the numbers, though, they're still economically negligible. So I would say we're on the way there, but not quite there yet. And if this becomes mainstream, probably we'll see more powerful coefficients.
Thank you. Did you do the same exercise about whether the social dimension also have an impact on the probability of default? Because that's a question that is.
That's exactly, I was going to make the comment, but you can imagine that in the S space, there is no agreement on what to measure in terms of impact or effect of the bond. So there is no, in the E space, we are just now reaching the point where we look at carbon emission. This is kind of an agreed measure. So in the ESG, the S is still very much at the beginning. And to conduct such an exercise, it would be quite challenging at this point. So that is why this really opens the point of the whole ESG investment space. How much there is still more to do and to agree in order to actually conduct this kind of exercises.
One personal question on my side. You've shown that there's a difference between the US and the EU. How do you explain that this difference? Is it basically a difference in preference, or does that reflect something else? For example, that for example, that maybe in Europe, the climate risk are priced through your probability of default, and maybe it's not in the US, and that is reflected. And do you have any insight about why you find such difference?
Yes, sure. So according to what we know so far, or how we interpret things, is that this has to do with preferences. So one first theory we had about this difference in the premia was, for example, whether companies in the US were more polluting, right? So do they have higher carbon emissions in general? And when you look at the data, the answer is no. So it's not as if it's like a scaling effect where in the US they pollute more, therefore the premia is higher. It simply has to do with preference. I think, though, one may ask what has to do with it, right? So perhaps it has to do with how aggressive investors arbitrage away any effect not related to, like, for example, supply demand imbalances, and therefore how much is left in the prices that we see in the market, in secondary market, of course, that does reflect the carbon premium. It's an open question to be answered.
So there is one suggestion in the chat why it is higher, just maybe because the rates are higher in the US, and so the spread would be higher. I don't know if that's fit. Maybe one other question on the choice of your variable, so basically emissions. So there's one question in the chat: why emission and not emission intensity, for example? But I think the question could be extended further. We know that, for example, past emissions are not a good it might not necessarily be a good predictor of what will happen in the future. And a lot of central banks and financial regulators are not trying to find a measure, for example, about the plans of firms to transition, and that might also be reflected in the preferences. So firms that have a high emission but a very good plan to transition very early could also see that reflected in the price. So why did you choose that, and do you think there are other alternatives to look at basically the polluting power in the future of firms?
Yeah, that's a good question. Well, the answer is pretty simple, actually. So carbon emissions in ton CO2 is better than carbon intensities, because carbon intensities are a ratio that's a function of revenue. So I could basically say that if I become more profitable, I pollute less according to my carbon intensity. And we don't think that's fair. That's not fair. I think that polluting the environment has to do with how much damage you do to the planet. That's more easily found in an absolute measure like CO2. I don't think investors are pricing how in terms of dollar billions made one company is less polluting than the other. That would be unintuitive.
Michela, do you have a view on that, or can I maybe move to the last question?
I agree. I mean, we had discussions all the time, and this question comes up quite a lot. And there are different views in research. We see that people use different things, but I think I share totally the view from Omar. I think this is internally the preferred measure. Yeah.
There's Lanois question, and I don't know if you want to take it, because maybe that's out of your field of expertise, but you say that no, and from the answer of the poll, it seems that disclosure, mandatory disclosure, is a key improvement. So, do you have a view or take on the new ISSB exercise on how that might standardize the new accounting standards, and how that can help standardize what is disclosed? I don't know if you know anything about that, if you have a view on this issue.
Perhaps I can honestly say that I don't know the standard, the IS. So any effort towards standardization and universal standard is definitely to be welcomed, as long as, of course, the burden shouldn't be okay. It's already very, very high, and going forward for companies, this is really a game changer in their accounting and management systems, and this is unavoidable. Yeah. So I cannot comment on the specifics of that particular standard. Yeah, I don't know if Omar has a different view. And these are our views, of course, not the BIS. Just to be clear.
Absolutely, yeah. I am totally with you. So I think that regardless of what standard it is soon time for markets to make up their mind and say, okay, these are the standards that make the most sense. We should follow them or homogenize across them, and then get to doing, right? Because if we don't, then we may actually be losing some of the precious time that we have in order to make this difference.
Speaking about not losing precious time, we already over time.